All right, to begin with, for today's class, just want to remind you a few announcements again. I sent you the email to correct myself from last week, right? For next semester, I will only offer one class, not two. Okay, only one. Okay, there's entrepreneur. However, the textbook, we're gonna use the same one. We're gonna use two textbooks, okay? So in case you have not purchased this yet, go ahead and purchase. We're gonna use this book and the other one, okay? I think for each one should be $5 if you order earlier, all right? So I can have this passed around. And when you finish this, please leave this with Yenzo. Leave this in the office. So for the other student, they can have the access. Okay, so we're gonna use two books. Entrepreneur eventually is the extension class of business law. Okay, so we're gonna use business law as textbook. Another one is high-tech startup. The reason why I want to use two books because high-tech startup is very thin, very simple book. All right, and I need to combine with business law to make the whole class more detailed information. So right now I have this pass around. You can write it down the title of the book, the publisher, and even the ISBN number. So highly recommend you can go ahead to start to purchase it. I think the school already announced the new schedule for fall, and I will announce my schedule very soon because my class is little bit deviate. Okay, little bit deviate is a deviation from the regular class schedule. So I will announce that by our next meeting. Okay, I will provide it to you. And again, for this semester, after the day, we only have two left. Okay, August 4th, August 11th, then we're done. Okay, and your final project it is a 15 minutes oral presentation. 15 minutes, and on the video you email to me. Okay, so you post it on any other website, then you email to me. Due date is August 26th. Would you please double confirm with me? August 26th is Sunday. Okay, Sunday afternoon 6 p.m. Okay, you send it the email to me, and highly recommend you can keep this as a public, so you can invite a lot of your classmates, your co-worker to view it. Okay, leave it there. All right. Regarding the topic, you can choose whatever you want. Okay, well, I believe for each class I try to give you inspiration. I think a lot of very good topic, very good topic. You can try to pick. Okay, it's not that difficult. So I don't have any limitation. Anything related to the financial accounting topic, you can pick up. So it's open. All right. Oh, by the way, some of the students approach me say, if you can have the group project, it is your choice, okay? You can have 2 students, 3 students, even 4 students as a combination group. However, if you have 2 people combined, then your presentation must be like 30 minutes. So I don't want you to take advantage, okay? Say 2 people, 15 minutes. It's not fair, right? So you can have a group, but for each person is 15 minutes. Okay, you can reduce the time limit to 12 minutes, but I don't want to see anything less than 12 minutes because this is a final project. At least I want to see this some information in there. Okay, not just a formality. All right. Hopefully you can learn something. Hopefully this final project can help you to find a job. I don't know. No. So don't just treat it as a final project. Use this as a learning opportunity, probably one project for you and as a reference in the future, hopefully. Okay. All right. To begin with, for today, I have another article related to accounting. I believe I briefly mentioned this from last week. It's about GAAP again. GAAP is big outline. So in case you want to search any final project topic, you can start with GAAP. Okay, online research, you say GAAP issue, you will see a lot of topics. And for this article, is one of the GAAP issues about the revenue. We all know GAAP stands for General Accepted Accounting Principle, right? So under the GAAP, there are a lot of guidance. And for this article related to the revenue. So I believe we talked about revenue last week, right? So when we talk about revenue, of course, you need to at least recognize. And there's one gray area. So say for example, your company is a construction company. Say Bay Bridge. Okay, your company just signed a contract. Okay, get a bid. And the government, grant you the contract. Can you recognize as a revenue right away upon the time you sign off the contract? Probably not. Because for this kind of construction, probably it takes about, 3 years, 5 years to complete, right? Even though your company may allow to recognize the revenue, but must be step by step, not at one time, right? But compared to the sales, if your company just received the purchase order, and your company expect to deliver the merchandise, say within 30 days, short period, maybe your company is allowed to, to enter this transaction as revenue, right? And this article is very interesting. It's very interesting, okay? Say, for example, your company, it's not exactly the same story, okay? I remember I talked about this before, right? In this article, this is one very interesting terminology. Probably you never consider this. Repo stands for a lot. Reposition, repurchase, whatsoever. Okay. Here, if you check online, okay, if you check Google, the good thing for technology is you can have the dictionary very, very handy. Repo here means sales and buyback. So what's the bottom line there? You sell something to the other party, so you are seller, and the other party is the buyer. You receive the money, but that is not the end. Okay? Under the repo mean you sell something to the buyer. However, you have another agreement, say within certain period, you will pay certain amount of money and buy it back. But if you choose to not buy it back by the expiration, the other party just keep whatsoever you sold to. Usually under the repo is either the bond, security, or real estate property.
How about the car?
But because the value may drop, okay, for anything you may sell to under the repo, the subject must be at least keep the value. At least the value could be kept or even go higher. Otherwise, there's no sense for the buyer, right? If somebody want to buy something, say $100, and then if the value of the subject keep on dropping, there's no security. And there's no incentive for the buyer, right, to pay you $100 right now, because if the value keep on dropping, there's no sense for anybody to pay you $100 right now. So for any property, if that property is suitable for repo agreement, usually is security, very stable and very strong value security, stock, bond, or real estate property. Okay, real estate property. Right, for example, A sold a real estate property to B for $1 million, right? So B paid A $1 million. However, other than this purchase agreement, they enter into another agreement, say within 5 years, A has option to pay say $1.2 million to B to get it back. Other than this, every month, because usually under the repo, even A sold the title to B, but A will stay there to use the property. So A will pay B for the monthly rent, say $5,000, $7,000, according to the market rate. So eventually on the table, you see the sales and lease back. But on the bottom line, eventually there's a loan. Can you figure out it? Right? It's more like a loan. More like B is the lender. B just lend $1 million to A. See that? B pay cash to A. And if A cannot pay it back by the time of maturity, B just take over everything because the title has been transferred to B already. Understand? And for every month, if A stay in the property, pay $5,000, $6,000, $7,000, on the face, it is under the name as a rent, but eventually it's an interest. Eventually it's an interest. And let me tell you why. From the standpoint of taxation, it is better off to configure it as rent for B. Why? Because if this is the rental income for B, then B can use depreciation to delay the income tax. You understand? If A and B enter into the lending, okay, borrow the money, okay, each penny received by B is become interest. And interest, there's no deduction. What's so much? Doesn't matter how much money B received, B must report on income tax return and pay right away income tax. But right now, A and B legally enter into as a rental. Then B can deduct depreciation first. Depreciation is not really tax-free, okay? Depreciation is more like tax deferral. So I just give you one expiration for your final project. Maybe you can do the research. What is the depreciation benefit? What is the depreciation? Okay, we may not have time to cover that in classroom, but from the standpoint of financial accounting, and also there's the same topic related to the taxation. So you can talk about depreciation. What is the rule of depreciation under GAAP? You don't need to talk about taxation because there are different rules regarding depreciation under GAAP, different from taxation. All right? So for this semester, you may consider to say, what is the depreciation rule under GAAP? This is not a big topic. Sufficient, for your 15 minutes. So go back to my example. So if A sold the property to B, but under the repo, really mean during the certain period, A may be able to buy it back. So on the face it's sales, but eventually it's a loan. So the problem right now is, under the GAAP, may A report this as a sales and report the profit? The reason why A want to report as a profit, because don't forget, this class is financial accounting. We are not talking about taxation. For financial accounting, okay, you want to increase the profit as much as possible. Understand? Because financial accounting statement is provided to any outsider, for your bank, for your investor, for your partner, for your joint venture. You want to impress the other people. So that is the reason why, from the standpoint of financial accounting, you want to maximize your profit as much as possible. So that is the reason why this company would like to report as sales right away. Eventually, under the GAAP, it is right. It is exactly what the GAAP require your company to do. Doesn't matter this is a real sales, doesn't matter this is a repo, as long as your company incur the sales, you must report as sales. But right now, this company MF Global, again, give you another example. If you want to pick out this company MF Global as your final project, you're welcome to do it. This is the news. This is not open article. This is just June 2012. I picked this up from New York Times. So if you never pay attention to the financial news, this is one of the news. MF Global is one investment company, and they got trouble. Okay, they got trouble. They lose a lot of money. And after this company faced this problem, GAAP coming in, SEC coming in, try to find out the problem, and they found out they have a big problem on their accounting report. A lot of problems. So this is another example. You say, you find a research, you say you want to do the research on MF Global. What happened? You say, what happened to MF Global? All right, just give you one example. All right. Okay, for today, we will talk about liability. All right, we will spend a little bit time talk about liability. Hopefully, up until this moment, okay. Hopefully, all right, we're almost, almost finished, right? Hopefully, up until at this moment, everyone, you all are familiar with debit credit. Hopefully, all right. One more time, for the financial accounting, the most difficult part is debit credit. All right, debit credit for the financial accounting class only designate as the left side, right side of the T account. That's all. That's all. Okay. Debit credit never mean increase or decrease. Never. All right. Never guarantee you decrease, increase. In the financial accounting world, is only designate debit to the left side, credit to the right side under the T account. That's all. That's all. Of course, in reality, okay, in the real accounting world, no more tier account, because right now everything is done under the software. So for accounting people, you will never see tier account anymore. You just punch the number to the space in the software. That's all. You just fit in the number. However, in your mind, you understand for each account there is a tier account. All right. For each account, say for example cash, right? For equipment. For today, we're gonna talk about equipment. For liability, for each account there is one tier account. All right. Debit only designated to the left. That's all. And credit to the right. That's all. All right. So hopefully, up until this moment, everybody, you should be very, very familiar with this idea. Okay? Otherwise, you'll get in trouble. All right. Let's go back to my original scenario. Okay. One owner opened up his or her business as a corporation. And after the funding, after the purchasing, after the sales, right now, we think about to purchase equipment, all right? And equipment is under which category? When we talk about equipment, it's assets. But what's the difference between equipment to inventory? Or different to account receivable?
Is something that's stable in the office for using, but inventory is something ready to sell.
So yeah, you are very close, but can you?
You can depreciate the equipment.
There's another thing I want to talk about. I will leave depreciation later on. Okay, we just right now we're trying to compare equipment to cash, to inventory, to account receivable, and what do you say is very close. We're gonna keep equipment for long term. So, yeah, liquidity. When we talk about liquidity, okay, eventually here. For next class, we will talk about parent company and subsidiary. All right, this is for August 4. Because that is very common for the big company. They want to own another company, all right? So you can imagine, for those of you if you work for a big company, one of the job for big company, the daily job, you cannot believe it. It's not just sales, not just R&D. Another job for big company is they every day they try to merge another small company. They try to acquire. So what's the big deal for you? So if you want to start out your own company, you may consider try to sell. On the first day you start out your company, your goal is try to sell your company to big one. You don't need to go around the very hustle IPO. The other day I just met one of my clients, and not very good luck. Okay? That guy eventually tried to go to IPO, and back to 2006, and there was a little bit chance, and they spent a lot of money. If you just want to prepare IPO, $1 million, that's minimum. $1 million you just spend for the law firm to the CPA. $1 million is not for SEC application, okay? Just try to prepare your financial accounting. Just printing your materials, that's it, all right? Not even talk about the road trip. You heard about road show, like Facebook. They just win, right? IPO, right? Before your IPO, your CEO must go around the whole nation, each big city, to attend, the conference. So $1 million not even cover it. So that guy spent a lot of money, but all of a sudden, the company's endorsement bank is Lehman Brothers. Unfortunately, Lehman Brothers pick out the wrong one.
There used to be more people going to IPO, but now it's more selling.
Oh, less and less in here, So it's very bad, very bad. So yeah, come back to my issue, okay? If you want to start your company, including this class and the next class, entrepreneur, one idea is eventually I can give you two ideas. One is try to go to as a franchise. Franchise. If your company is more like a retail company, retail business, doesn't matter service or goods. If your company is related to the retail style, consider franchise. Because franchise is a lot easier than IPO. Franchise is more like IPO, right? Once you go through franchise and your brand name is being recognized nationwide, it's just like IPO. The people pay you continued money to run your business. So that is one type of business. But if your business is more like R&D business, high-tech business, then consider to be sold, to be merged. And when I sit down with this unfortunate gentleman, and he said, after his IPO failure, then he worked for another company, and that company is another good example. And his boss sold the company for $500 million. $500 million for one deal. So eventually, at the age of 45, $500 million, then semi-retire, you can do it, you can just stay home, whatever you want, So another consideration is for next August 4th, for next class, we'll talk about that. How does company own another company, invest? But for today, let's talk about equipment, liquidity. There's a difference. When we talk about equipment is different from inventory, because inventory we can see it can be turned around in very, very short period. But when we talk about equipment, like a truck, machinery, the building, land, whatsoever, all right? Sometimes even include the patent, know-how, all right? We're gonna keep this for a while. So another issue is depreciation. Okay, we're gonna talk about depreciation a little bit, very briefly. Okay. However, for this class, because it's gonna be very short, okay, I will focus more on the concept as a present value. How many of you already took finance? How many of you took finance already? Finance is not easy one, okay? If you have not, if you have not taken yet, okay, it's not easy one. Okay? If you think marketing is tough, then finance probably is 10 times tougher than marketing. For the MBA program, I think the finance is the most difficult one. That's my idea, okay? Because we want to talk about the present value. Present value, the concept is very easy because if you receive $1 today, of course this $1 is much more valuable than the $1 you're gonna receive 1 year after. Some people say, I promise you, I will give you $1 exactly 1 year after, and you trust it. You think this person gonna keep the promise. But you can negotiate, say, how about you give me today? If the other person say yes, guess what? You will not receive $1. You will receive, I don't know, 85 cents, 87 cents, I don't know, 93 cents, because $1 you're gonna receive year after convert to $1 today is not equivalent. Because there's time value, interest rate, right? We're gonna talk about this. Okay, it's a little bit complicated, but hopefully as a foundation, if you have not took finance yet, at least as a preview, okay, what's the concept of present value? Okay, let's have example number 1. Your company purchased a building, okay? The value is $1 million. If your company pay $1 million cash, this is the easy one, okay? How will you enter into your bookkeeping? Which account you gonna pick? Or which 2 accounts you gonna pick? Anyone? Cash account is easy, right? So you spend the cash, so your cash, what? You want to, which side? Yeah. Hopefully everybody agree, okay? Not just one person, right? How about the other one? The other account you want to pick? Building. Just building, okay? And for big company, probably you have so many building, okay? So you can build in number 1, or you give it identify. You may have so many buildings, okay? So, so for this example, you can see this is under assets, under the assets. So assets reduce, assets increase. No problem, right? All right. Let's talk about depreciation. Okay. Assuming, I just give you the easy number. Assuming the building. Okay. By the way, when we talk about building, there are 2 parts. Okay. So you better off divide it as a 2 part. When we talk about real estate including 2 portions. Everybody understand?
Yes.
One is land. The other one is improvement. All right? So when you purchase this, we better off. So according to your purchase agreement or according to the county assessment value, if the land value is 300,000, then you have improvement. You can say this is building. This is just an example, okay? There is no absolute ratio. There is no absolute ratio between the land and the building. Okay, by the way. Just give you one idea, okay? When we talk about the value of the real estate, there are 2 portions, land and the building. If we are talking about the high value area, for example, you purchase the property in downtown San Francisco, financial district, compared to the rural area, okay, Stockton. The total value difference because the land value is different. All right, understand? For the improvement value, maybe change a little bit, but not too much. All right, and also in the future, if the value increase, appreciate, also due to the land, also due to the otherwise improvement value reduce every year. All right. So we have two portions. So, but again, this is only my example. I don't want you to be misled. There's no absolute ratio between land and building. This is just my example. Then we talk about depreciation. Always keep this in mind, okay? Always keep this in your mind. In order to do the depreciation, never do depreciation on land. Land value never depreciate. Same as financial accounting as to taxation. You cannot do depreciation on the land. Never. Okay. However, for improvement, remember, okay, owning investment property, only investment property, you can do depreciation on building. I can say if this property is your owner occupied, as your home, as a residence, residential owner occupied, you can never do depreciation. Understand? Everybody follow me? So another inspiration for you for your final project is depreciation. Okay, I mentioned it already. Okay, you need to find out what is the depreciation rule under the GAAP. So here, because this is for business, okay, by the way, I should say for business or for investment. All right? Can anybody tell me what's the difference between for business and for investment? But before you give me the answer, I'll just tell you, for the depreciation purposes, they are the same. But here, for this company, what's the difference between investment and business? What's the difference here?
This is for usage, and investment would be maybe lend out to some other people.
Yes, good enough. If your company purchased this building for its usage, its own usage, owner occupied. However, this is different from residential owner occupied, right? Because your company purchased and your company use it to run the business. So this is for business. So it is okay to do the depreciation. The other thing is your company purchased it and then rent it out. You don't use it, but you rent it out to get income. Also, you can do the depreciation. So for here, it's no problem, right? So for the tax law, okay, any commercial building for taxation purposes, it is 39 years and a half for depreciation. I don't know why 39 and a half. I don't know why not 40 years. But for taxation, for residential, other than owner occupied, okay? If residential, when we say residential is condo, single family home, townhouse, or anything under 4 units. People say fourplex. The building is under the 4 or under 4 is also residential. For residential rental property, it's 27 and a half. I don't know why. It's very strange. But anyway, I wanna test you for the year, okay? So if we just give you the even number, 40 years, and we use a straight line, mean average depreciation, you can calculate for me 700,000 divided by 4, this is how much? This is 10 something, right? Or 12 something. 12 something, right? So for every year, am I right? Every year your company can depreciate by say 12,500. close enough, all right? So, can you tell me, by the end of the year, when your company going to do the depreciation, how are you gonna do? There's one, it's called control account. Control account. It's called accumulated depreciation. And you can designate this accumulated depreciation linked to improvement building number 1. Understand? For real life, depreciation is very, very complicated. Again, accounting people never lose job, okay, because the company really needs you. The company cannot let you go, all right? So, by the end of the first year, your company deduct 12,500, for example. All right, here, you have accumulated. This is the control account. In our book, you designate as XA. So we have here. This is not exact number, okay? Just give you one example. How would you gonna enter into another one? What is another matching account you want to use? You want to pick? When you have accumulated depreciation, what is the other account you want to pick?
Depreciation.
Expense.
Operation.
If you combine together, you got the right one. Depreciation expense, right? It is expense, all right? It's called depreciation expense. So it is expense. So and also you better off designate this to number 1, okay? Because a lot of depreciation, all right? And when we talk about depreciation, remember that when the expense increase is under deficit. So far so good, right? So by the end of the year, 12,500 become expenses, and this number gonna reduce your net profit. Understand? So far so good, but another problem. Next year, something happened to your building, all right? Say, for example, in a certain year, your company spent $100,000 to do the new roof, or to do the new AC, whatsoever. Your company spent $100,000 as an improvement. Another terminology is called capital improvement. $100,000 on the building. Say cash, all right? How are you gonna do? When your company spend 100,000, so you have the cash reduced, right? So this is the easy one. But how about the other?
Improvement.
Again, improvement, right? You put this $10,000 here as improvement. However, another problem come here. This $100,000, even though the total number added on the building, the improvement, however, guess what? What's the problem? Can you see the problem here? Or issue? Can you see the issue here?
Can it be depreciated?
Yes. Can it be depreciated? The answer is yes. Affirmative. The problem is not there. The problem is whether or not, because the answer is yes. The issue is how will you depreciate it? Understand? When you do the depreciation, it's not 700 plus 100, deduct 12,500. No. For each item, you need to separate it. Because roof is not 40 years depreciation. So the life is different and the starting year is different. Understand? So that is why depreciation is so complicated. So complicated. For the whole building, I just simplify it. But in the real life, you need to itemize, separate depreciation. For example, you spend the money on the landscaping. Landscaping, I think, is a 5 years depreciation. You have the paved way, driveway. Driveway is different. Underground sewage is different. AC pipe is different. Everything is different years, different life. So make the accounting job so very secure. The company cannot let you off, okay? Unless the whole company closed down. Otherwise, accounting people is always the last person leave the job. Always. All right. You see this. All right. Let's just simplify everything. So right now at this moment, we can see it's 800. We just simplify. Okay. The value is 800, and say for example we depreciate by 3 years. We by 3 years. Can you help me? If 3 years, what's the number?
You mean,
For 3 years. Every year is the same. Oh, by the way, after the next year we have different, okay? So I don't want to make it complicated. We just leave this alone, okay? Assuming no such re-roof, okay? We just want to give you a very simple idea. So there's no any improvement from the beginning. So originally it was 700,000, but right now we have 3 years. Can you do me a favor? 3 years is how much? 37,500, right? Am I right? If I make any mistake, please correct me. All right? How about right now? How about right now? Your company sold the property at $690,000 on certain days for cash, by the way. All right, 690,000 cash, and no repo. By the way, keep everything simple. It's real sales, no repo. So when you receive 690, you want to do what? Debit cash by 690, no problem. Then you need to clean out the mess. We have a 690 debit. We know on the credit side, it must be also 690. Total, I mean total. How are you gonna do? It's a lot of mess there, okay, by the way. We need to clean up, okay? Anybody give me an idea? This is a good final project. You can make out one thing like this, from purchase to the sales. Of course, in between you do the depreciation or do the improvement.
you saw the land first.
We close down the land first, right? Oh, by the way, yes, we close down the land. We need to close down here, all right? Because everything, right? Oh, by the way, from this number we can see you got the loss, right?
Yeah.
Because total you pay 1 million, but right now you only sold 690. We know you recognize the loss, but we need to clean out everything. As I say, I don't want to see the number, okay? I want to step by step. So we need to close out this. So it doesn't matter how many monies, how many numbers I put in. The final result gotta be 690. Let's see how can we do it, okay? We have 300 here. If it is not 690, then we need to increase the debit side to make everything balanced. All right. So we have this closed out, no problem here. Then we have a 3 years depreciation, right? Understand? We have no more accumulate. We have this closed also. We just have the number here. Not necessary there. Okay, just put on there because we need to close this number off. close this. What else? We close land, we close building, we close out accumulate, right? Then, what else?
Expense.
Because right now it's not balanced. At this moment it's not balanced. If you add 690 to 37,500, that is only 7 something.
Loss?
Everybody? Give me the number, okay? 690 plus 37.5. This is 7,500, right? So on your debit side is only 7,500. But right now you have 1 million on the credit side.